Risks to global financial stability have lessened in the last 6 months, as the IMF's risk index shows in this chart. But global economic growth remains weak, and financial markets in Europe are fragile. In recent months, there have been signs of financial stabilization thanks to policies adopted in the euro area, including the agreement on funding for Greece, the European Central Bank's lending to help banks refinance over the next 3 years, and a more flexible and better funded plan to manage crises. But European banks continue to face pressures, such as their large holdings of government bonds that are no longer considered risk-free, weak growth in the euro area, high debt repayments, and the need to strengthen their capital cushions to regain investor trust. These pressures have prompted banks to reduce their size and shrink their balance sheets.
So far, what we have had is that banks are moving along the good deleveraging path. That means raising capital and selling non-core assets and non-core business lines. But it's very important that the leveraging remains good and doesn't become bad.
Despite some recent improvements, the financial system is still under stress.
Well, the biggest risk is that there could be a large-scale synchronized deleveraging in Europe that would take a very serious toll on credit to households and firms. That would lead to significant falls in asset prices, and this would have adverse repercussions on economic activity, both within and outside of Europe. And in order to avoid that problem, it is fundamental that the right policies are pursued at the national level and that the right actions continue to be taken at the European level to put us on a clear path towards further fiscal and financial integration. The key message is that the authorities at this very decisive moment cannot afford to relax, cannot pause, because the answer to this is more and better Europe.
So far, the impact of Europe's deleveraging process on emerging economies has been manageable, but risks and challenges remain.
Emerging markets need to remain vigilant because they need to address the homegrown vulnerabilities that they have in the form of rapid, persistent growth in credit, many of them. And they also have to have enough policy space to deal with potential sharp reversals in capital flows.